Stop. Right now. While this reaches you, the core engine of the world's most watched silver exchange is already moving. Quietly, precisely, through a process most investors haven't even begun to understand. Spot silver is sitting around $69.82, but the latest COMEX report tells a very different story. Roughly 79 million ounces classified as registered, over 252 million ounces sitting as eligible, a combined total near 332 million ounces. That's not theory. That's not a thumbnail. That's not recycled noise from someone else's feed. That is the structural foundation of the most important conversation happening in commodities right now. And almost everything you've read about it, incomplete, surface level, or simply wrong. Because we're not starting with opinions. We're starting with what the system is reporting itself, and then asking the questions most people are too uncomfortable to ask. So if you want analysis that doesn't just follow the market, but exposes how it actually functions, stay with me. Because what's unfolding here isn't slowing down. It's accelerating. This data snapshot was anchored on March 28, 2026, 1832:11 UTC. By the time it crossed into India Standard Time, it was already March 29th, and that shift, those few hours, is where most analysis breaks down. Because when people say latest silver data, they're mixing systems that don't run on the same clock. Spot prices update in real time. Stocks closed on Friday. Warehouse reports lag by days. London vault data comes monthly. ETFs follow their own schedule. And online headlines? They update every few minutes, accurate or not. That's not one data stream. That's noise. Silver trades across time zones. Physical reports move slower than price, and the internet moves faster than both. Confuse those clocks and you manufacture chaos. Now look at the numbers. Silver is trading around $69.82, but across the same trading window, different sources printed $69.62, $68.84, even $67.80. None of them are wrong. They're just stamped at different moments in a fast-moving market. So why does it feel like the system is breaking? Because the answer isn't on the chart. It's in the vaults. The latest COMEX report, dated March 23, shows 79 million ounces registered, over 252 million eligible, roughly 332 million total. And that distinction? That's not technical. That's everything. Now focus. This is the line most people miss. There's a difference between metal inside the system and metal actually classified for delivery inside that system. Registered silver? 23.8%, eligible silver, 76.2%. The metal exists, but not all of it is committed. And that gap. That's the ratio the entire silver market is obsessing over, debating, misreading, weaponizing. Now layer in what's happening right now. CME delivery data, dated March 27th, confirms something critical. This isn't theoretical. Contracts are moving, settlement is active. Delivery is scheduled. The system isn't being discussed, it's processing, and when a system processes under pressure, every update carries weight. Because this is no longer just about price. It's about what's happening beneath price. Now zoom out. London, one of the largest physical hubs on Earth, reports 27,065 tons of silver, down 2.4% in a single month. Different vault. Different continent. Different reporting cycle. Same signal. Not proof of collapse, but undeniable pressure. So look at the structure forming. $69.82 silver. 79 million ounces registered on COMEX. London inventories declining. Active delivery notices hitting the system. Individually, nothing breaks. Together, they show a market no longer behaving like a stable commodity. They show a system where paper, physical, and pricing are no longer aligned. And that's where ETFs enter the picture. SLV, over $46 billion in assets, closed around $63.44, trading above its own NAV, which means the market isn't just pricing silver, it's pricing access. And that shift, that's where things start to get uncomfortable. Now ask yourself this: why does that premium matter? Because the moment silver turns emotional, the instruments around it stop behaving like trackers and start behaving like signals. When an ETF trades above its NAV, that's not just price distortion. That's urgency. It's investors saying, "I'll pay more just to get exposure." This is no longer about will silver go up. It's about how you own it, what structure you trust, and what premium you're willing to accept for access. Look at PSLV NAV up 10% in a month. Market price up nearly 17%. Same metal, different behavior. Why? Because PSLV isn't just a ticker anymore. It's a statement about physical backing, custody, and conviction under pressure. Now add miners. First Majestic Silver Corp. Surging, Wheaton Precious Metals Corp. Jumping. These aren't normal moves. That's equity markets front-running a narrative they believe is real. So step back. Silver above $60. ETFs rising, miners accelerating, COMEX, inventories shifting. London declining, deliveries active. Paper says one thing, equities say another. Physical whispers something else entirely. And then comes the data that changes everything. 5 consecutive months of physical outflows, 65 million ounces delivered in a single month, 474 million ounces in 2025 alone. Registered silver down 75% from 2020 levels. This is no longer a chart story. This is a flow story. Solar alone pulling 200 to 250 million ounces a year. EVs, semiconductors, AI, all competing for the same supply. And beneath it all, an estimated 820 million ounce deficit since 2021. Let that sink in, because flows don't explode overnight. They tighten quietly until suddenly, they don't. Now this is where the narrative changes. An 820 million ounce structural deficit built over 5 years, at the exact moment the world is scaling technologies that require silver. That's no longer internet hype. That's structure not because it guarantees a price spike tomorrow, but because it reframes silver as a strategic metal in a system built on conductivity, miniaturization, and energy transition. But here's the nuance most people miss. Industrial users don't line up at COMEX vaults. They operate through contracts, refiners, long-term supply chains. So industrial demand explains tightness, but not necessarily who is taking delivery. And that question changes everything, because the data points somewhere else. In January 2026, JP Morgan Chase issued 99% of 8.1 million ounces in a single day. While open interest surged, buyers were arriving faster than metal could move. This isn't retail stacking coins. This is institutional capital moving size, and when the players change, the game changes. Suddenly, warehouse reports aren't statistics. They're signals. Then escalation. Sprott Inc. doubled its raise to $2 billion, enough to absorb 18 million ounces. That's 16% of registered COMEX supply in one move. At the same time, metal flows east, premiums in Asia spike, Shanghai trades consistently above COMEX, and then geopolitics enters. China reclassifies silver as strategic exports don't slow. They stop. A major supplier shuts the door, and that doesn't stay local. It ripples through vaults, refiners, pricing systems globally. To some, this looks like noise. To others, it looks like a slow-motion monetary shift. And the internet does what it always does. It amplifies the signal until no one can tell the difference anymore. Right now, the internet is screaming. YouTube titles claiming the March COMEX window could break the system. Reddit threads tracking every inventory shift, every contract change, every anomaly. A drop of 18 million ounces here. Timing coincidences at CME there. And suddenly, every data point becomes proof. But look closer. This is how modern market mythology forms. Not from one verified event, but from dozens of half-signals stitched together by a community that already believes the system is under stress. Now, here's the part most silver channels avoid, the counter-argument. Not dismissal, but disciplined analysis. A recent breakdown addressed the viral claim. 400 million ounces in open interest versus 100 million registered means COMEX is near default. Their response? There is no strong evidence of a March default risk, because open interest is not delivery demand. Most futures are rolled, closed, or cash settled before delivery even begins. Even the widely shared 98% delivery rate claim, built on a flawed denominator, a misunderstanding of how contracts evolve over time. And here's the key detail. COMEX delivery doesn't mean trucks leaving vaults. It means warehouse receipts changing hands. Ownership shifts without immediate physical movement. That doesn't mean nothing is happening. It means the most cinematic version isn't always the correct one. Their estimated probability of default, 0.001%, about 1 in 10,000. Not emotional. Not viral. Just disciplined. And in a market like this, that distinction matters more than ever. Let's be honest. Parts of the skeptical argument are strong. Delivery months differ. Open interest is misunderstood. And a true exchange failure wouldn't be a clean bullish signal. It could freeze pricing, destroy liquidity, and trigger interventions no one can model. A real bullish thesis shouldn't depend on collapse. It should stand on structure, demand, supply constraints, monetary distrust, and observable positioning. So who's right? Both, at different layers of the same market. The scarcity camp may be directionally correct. Physical demand, industrial use, and strategic accumulation are rising. The skeptics may also be right. Many viral calculations are flawed, and a COMEX default is far less likely than the internet suggests. These views don't cancel each other. They reinforce each other. Because tension is what makes this market volatile. Now look at reality. Silver near $69.82, SLV at $63.44, PSLV at $22.63, miners surging. 79 million ounces registered. London inventories falling. Deliveries active, 474 million ounces moved in 2025. Some call it a crisis. Others call it misinterpretation. But the real question is this. What does it mean to own silver when trust between you and the metal begins to break? If trust were intact, no one would care about vault flows, premiums, or delivery. But they do, because silver isn't just a price. It's a system. And you saw it. You followed the data, the vaults, the ETFs, the contradictions. Which means you already know. This isn't about price, it's about structure. Most people scroll past. You didn't. So if this changed your view, share it. Subscribe to Golden Exchange before the crowd catches up. And ask yourself, when price, inventory, and behavior all conflict, what do you trust? Invest with logic, never emotion.